Hey everyone, welcome to the RBI Circular January 2026 part 1. So we'll be discussing about the circulars that came in January 2026. So let's start the discussion, guys. Hello everyone, my name is Prateek Sir. By qualification, I'm a chartered accountant. In case if you are looking for a finance related group for your regulatory body preparation, you can definitely check out my Telegram group. If you type CA Prateek Finance on Telegram, you will get the link of my Telegram group where I frequently share finance related content, and in case if you are having any query, you can definitely reach out to me on that. So guys, these are the circulars which are posted on 1st of January, and we'll be starting with the NBFC related circular, the Reserve Bank of India NBFC concentration risk management and prudential norms on capital adequacy. So let's start with this prudential norm on capital adequacy amendment direction. So these are the amendment directions. So no worries at all. If you see the January section related to the RBI circular, you can see so many circulars, but no worries at all. Most of them are amendment direction, and let's suppose if some direction is there for the scheduled commercial bank, then it is also there for the rest of the category of bank like payment banks like AIFI and RRBs and rest of the categories of the banks, right? So it's the same circular only, right? The concept will be the same only. So we'll be covering it in a very crisp manner. So definitely you can later on check out the other parts as well for the best coverage, and plus rest of the months are already covered on the YouTube channel of All Your Board. You can definitely check out the playlist related to RBI circular. So guys, let's get the discussion started related to the NBFC prudential norms on capital adequacy amendment direction 2026. Now what do you mean by prudential norm? The word prudential came from the word prudence. And what is the real meaning of prudence? Intelligence backed with foresightedness, right? Intelligence backed with foresightedness. So here are the prudential norms of RBI related to the NBFCs, okay? So let's start the discussion, guys. So we were already having the capital adequacy direction related to 2025 for the NBFCs. This is just an amendment, okay? This is just an amendment. These rules decide how much capital NBFC must keep against the different types of loans. So NBFCs are also giving loans and advances, right? And that is an asset for NBFC. Why? Because this loans and advance help the NBFC generate future economic benefit in the form of interest and principal payments. So I can say that yes, NBFC is also giving loans and advances, loan number 1, loan number 2, loan number 3. And likewise, there are so many loans and advances given by the NBFC, but the problem is every loan is having a different risk attached to it. All are assets, definitely all are the assets only, but every asset is having a different risk weight assigned to it. And that's why we consider risk weighted assets in the capital adequacy ratio calculation. What is capital adequacy ratio? CAR, capital adequacy ratio, your capital divided by your risk weighted assets. Capital divided by your risk weighted assets. So how much amount of capital you are having as compared to the risk weighted asset. What is risk weighted asset? Every asset carries a different amount of risk. So that's why we do a weighted average calculation of all the assets. So let's suppose loan number 1 is given to a small company, right? Loan number 2 is given to a large company. Loan number 3 is given to the government. So can I say that the loan that you have given to government is having almost negligible risk? The loan that you have given to a large corporation is definitely having some amount of risk, but the loan that you have given to a small company will be having an adequate amount of risk, right? All are assets, but we need to calculate risk weighted assets. Risk weighted assets. So we will be giving different weights. RBI has already specified all the weights that you have to give, right? So this direction is related to the changes in the risk weights only, which NBFC have to give. Now on a review, RBI feels that certain good quality infrastructure project, when the NBFC is giving loans and advances to the infrastructure project loans, RBI thinks that they deserve a lower risk weight. Why? Because the infra projects are good quality in nature, So why not to give lower risk weight? Sir, what will happen if we start giving the lower risk weight? Have a look. You need to maintain the capital adequacy ratio. if the risk weighted assets, if the risk weighted asset is high, the CAR will be low. The CAR will be low, and this becomes a problem because this is the bare minimum. There is a criteria, there are thresholds for the bare minimum CAR, capital adequacy ratio, that RBI has stated, right? So all the commercial banks, NBFCs have to keep that much amount of CAR. Now, when the RBI increases the risk weight, your denominator will go up. If your denominator will go up, your CAR ratio, capital adequacy ratio will come down. This creates a problem, and this puts pressure on the financial institution, the regulated entity, because they need to maintain a certain amount of CAR, capital adequacy ratio, right? So RBI here has relaxed the restriction. Why? Because the loan is of good quality. So what's the problem, right? If the loan is of good quality, let's lower the risk weight. If you lower the risk weight, the capital adequacy ratio will be high. If the capital adequacy ratio will be high, then the NBFC don't have to maintain more and more capital in front of the risk weighted assets, right? Sir, what do you mean by good quality infrastructure project? Is there a definition? Definitely there is a definition, and we'll be studying the definition in the next circular. Okay. So RBI has issued the amendment to reward early repayment behavior. Early repayment behavior. So there are certain criteria in this particular circular related to the early repayment behavior as well. No worries at all. Let's look at the amendment. So this is the amendment direction. It's not like that you have to read hundreds of pages. It's just a small amendment that you have to read. The very first one, loan to high quality infrastructure project. If you are an NBFC, you have given a loan to a very high quality infrastructure project. That's great. And where the borrower has repaid at least 2% of the sanctioned project debt. That's even better. So you have given a loan to the high quality infrastructure project. The borrower has also repaid 2% of the sanctioned project debt. That's perfect. Your risk weight will be 75. Your risk weight will be 75. But in case if you have given a loan to high quality infrastructure project and the borrower has repaid at least 5%. Earlier the borrower has repaid at least 2%. Now the borrower has repaid at least 5%. So it is even better. You will be getting even a lower risk weight. So 75 and 50 up to 2%, at least 2%, sorry, 75, at least 5%, that's even better. 50% only, 50 risk weight only will be given, right? If the borrower has already repaid the 5% of the money, then why to, kind of assign a higher risk weight? It will be even fine if the risk weight is 50. Now this amendment is important. You have to remember these risk weight. Plus you need to remember the definition of high quality infrastructure project as well in a very crisp manner that I'll be definitely teaching you in the very next circular only. Right, so this is the amendment and it is going to be applicable from 1st of April 2026. So नए financial year से ये apply होने जा रहा है. It is going to be applicable from the new financial year starting from 1st of April 2026. Right. So guys, I have summarized each and everything as well for you. After every circular, you will be getting the summary pointers as well, so that you can quickly go through the summary pointers once you are done. Or maybe let's suppose, you are running short of time, you have other subjects also to cover. So just directly read the summary pointers. But once you have to watch this video, after watching this video, again and again, you can just directly read the summary pointers and definitely that will help you in the quick revision. Okay. Next one is related to the NBFC. Concentration Risk Management Amendment Direction. So in this particular risk management direction, the NBFC Concentration Risk Management Direction, the definition of high quality infrastructure project is defined. Okay. So RBI has inserted a new provision in the para 4 sub para 4 to formally define the high quality infrastructure project. You don't have to remember all these paras and sub paras and all. Just remember in the NBFC CRM amendment direction, the high quality infrastructure project definition is stated. And what is the purpose of it? Ensure only genuinely strong projects are getting the regulatory benefit. So the good high quality infrastructure projects are getting the benefit in terms of lower risk weight. If the risk weight is lower, no worries at all. Your CAR will be high. If your CAR will be high, That's even better, right? From the compliance angle. So this definitely ensures that genuine, strong projects are getting the regulatory benefit. Avoid the misuse of lower risk weight. We don't want these lower risk weight that NBFCs are started, kind of taking the advantage of this particular circular in a wrong way, or I can say they are just kind of misusing the circular in a wrong way that we don't want. Plus we want to protect the NBFC from the concentrated risky exposure, right? And that's why this definition is included in this concentration risk management. What do you mean by concentration risk management? The risk management concentrates when you are giving loans and advances in only one particular area. So let's suppose you are just giving loans and advances to infrastructure companies. Somewhere or the other, we need to define a boundary which is a high quality and which is not a high quality. So this is the definition of high quality. There are broadly 6 pointers in it. Okay, there are broadly 6 pointers in it. So one by one we are going to discuss the pointers. So you have to cover this definition in a crisp manner. It's not like that you have to kind of read it line by line and remember each and every word from this definition. No, that's not required, but a basic understanding of this definition is highly required, right? So now let's discuss one by one about each and every point. So the first point is the infrastructure project has completed at least 1 year of operation post achievement of the date of completion of the commercial operation without breach of any material conditions stipulated by the lender, right? So this is the condition number 1, which is related to the minimum track record. So what should be the minimum track record? It should be at least 1 full year of operation, right? So the project must have completed the commercial operation, at least 1 full year of operation, plus no breach should be there in the material loan during the period. The project should already be running, that's the main motive, right? Successfully for 1 year and not under construction. This is the condition number 1. Second one is the exposure is classified as a standard asset in the books of the lender, right? So for the lender it is a asset, right? So it should be a standard asset. What is a standard asset? That means it is regularly servicing the borrower is regularly servicing the interest and the principal payment. That means it is not a NPA. It is not a NPA, right? So it should be standard. That means no default, no special mention account or no NPA, right? Clean payment history should be there. What is a SMA special mention account? That means if it gives you the early warning signal that it might become an NPA. What is an NPA? If you are unable to receive interest or principal repayments even after 90 days of becoming overdue. Let's suppose if the advance becomes overdue today, if the installment becomes overdue today, and for the next 90 days you are unable to recover anything in the form of interest or maybe principal or both, then after 90 days it will become NPA. But soon before becoming NPA, we'll be getting the early warning signals also, right? So there is a particular criteria for the special mention account also. It should be a standard asset. That's the main motive. Third one, the borrower's revenue depends on right granted under the concession or the contract by the central government, state government, public sector entity or the statutory regulatory body. So what is the third condition? The revenue backed by government, PSU or regulatory contract. So if the borrower's revenue is coming from central government, state government, PSU, statutory body or regulatory body, and the contract must protect the borrower's right for the full concession period. Like say for example, if I talk about the toll road operated under NHAI concession, right, power plant selling plant under the DISCOM PPA. So these are some of the examples of the condition 3. We just have to understand the crux of it. If it is falling in the 6 criteria, then it will be treated as a high quality infrastructure project, right? If it meets all the conditions, all of the following conditions, then it is going to be treated as a high quality infrastructure project. The fourth one is strong lender protection mechanism. The protection mechanism are quite strong if I talk about the lender, right? So the contract must provide a high degree of protection to the lender. The lender is quite very well protected, maybe through the escrow mechanism. So there is a surety of receiving the payment, right? So definitely, or the NBFC has equal rights, legal charges against the land, plant and machinery, right, project assets of the borrowers. That is also again a very strong position if I talk about the lender. Or the early termination protection. So if project is terminated, then lender gets the minimum termination payment. Step in rights available. So that means lender is somehow or the other protected. Bank can take control even if the project fails. The lender is quite on a sorted note. Right, that's the fourth condition. Fifth one, the borrower has sufficient internal or external financial arrangement to cover the current and future working capital. The borrower, the person who has taken a loan, can easily cover the current and future working capital needs requirement as per the project and as per the assessment of the lender. And the sixth condition is borrower is restricted from acting to the detriment of the lender, example being restricted from issuing additional debt against or further encumbering the cash flows or assets. So somewhere or the other the borrower is restricted, right, because the lender has a skin in the game now. The lender has given adequate amount of capital in the form of loan, right? So the borrower cannot harm the lender's interest. So it's not like that, say for example, a lender has given some amount to the borrower and again the borrower is further raising additional debt. So somewhere or the other the borrower is restricted from raising additional debt or pledging the assets, right? So the lender consent is required, then that's fine. Without the lender consent, it will be treated as harm to the lender, right? So these are the points. If all the six conditions are getting satisfied here, we'll be classifying it as the high quality infrastructure project. And if we classify it as the high quality infrastructure project, then accordingly any of the percentage weight is going to be applicable. Okay, so we have to learn it in a crisp manner only, and here are the summary pointers that you need to cover. Next one is just a presentation and disclosure requirement related to financial statement. So the RBI Commercial Bank Financial Statement Presentation and Disclosure Amendment Direction 2026. So this is nothing but a disclosure requirement. Okay, some banks, especially the foreign banks, okay, especially the foreign banks who are operating in India, they are again required to mandatorily deposit some amount with the Reserve Bank of India as per section 11 subsection 2. So this is in accordance with section 11 subsection 2. The foreign banks are required to deposit a particular amount with the Reserve Bank of India. As of now, according to this circular, the RBI will be allowing the part of the deposit to be earmarked as credit risk mitigation for the derivative exposure. So if the exposure is related to derivative, the deposit can be clearly earmarked. That means you need to clearly define the deposit as credit risk mitigation, CRM. So this is nothing but a requirement. So in your financial statements, in the notes to accounts and the notes and instructions for the compilation, basically your notes to accounts only, definitely the bank can specify the amount under the credit risk mitigation in the name of credit risk mitigation, right? So this is just a disclosure requirement, not important from the examination point of view. Okay, no doubt I have given you the section 11 subsection 2 also. You can read the requirements, but as per my understanding, this is not going to be an important thing for the examination. Why? Because it is just a disclosure requirement. Okay, it is just a disclosure requirement. Next one is related to returns, the Department of Payment and Settlement System. Submission in CIMS. There are certain returns like MTSS business, like WLA, right? Basically your white label ATMs. Then we have PPI statistics, we do have PPI consumer grievances as well. So there are so many types of returns. And what is CIMS? You need to know the CIMS. It acts as a central repository. So this is a central repository for all the statutory return. Whatever returns the regulatory bodies are going to file, it can be related to digital lending data as well. It can be related to the statutory returns. So for ensuring the better accuracy and faster analysis, because this CIMS portal is using definitely multiple data related tools like big data management. So it can again deal with a vast amount of data. It is also having data mining, text mining. So many visual tools are also included in the CIMS portal, so that it is easy for the RBI to have a composite central repository and for the data analysis purpose also. So it is nothing but the timeline, the return code of and the return name is stated that you have to submit via the CIMS platform. Not so important for you guys. You don't have to remember the name of the returns, the return code and the frequency, not required for your examination. Just a quick understanding of CIMS portal is again required here, right? Then the next circular is related to credit risk management amendment direction, right? So we'll be just having a quick look related to the commercial bank credit risk and management direction, and rest are the same only. So we can see that there are so many directions related to only your credit risk management. Okay, so all these are covered in the upcoming direction, credit risk management. So it is related to AIFI, NBFC, rural cooperative bank, UCBs, RRBs, LABs, right, SFBs and so on. So we'll be just discussing about the commercial bank direction. Rest will again be sorted, right? So the commercial bank credit risk management direction published on 5th of January 2026. The whole idea is lending to related party. What is the focus area here? Lending to a related party. What do you mean by a related party? Somewhere or the other the party is connected to the regulated entity, right? Somewhere or the other the party is connected to the regulated entity. Let's suppose if I am dealing with my relative, highly likely that this transaction is going to have certain biasness. That's called as a related party transaction. If I'm doing a transaction with my relative, definitely the transaction can be a biased transaction, right? So lending to related parties, if you are lending to related parties, the governance tightening is required because of the biasness involved in it, right? So this is a major governance oriented amendment. This is going to be a major governance oriented amendment. The RBI has almost completely rewritten the framework on the lending to the related parties. So earlier we used to have a different framework, but now it is completely changed from the earlier one, and this is now related to the lending to the related parties. Almost all the provisions in this particular circular focuses on managing the related parties only and how we can tighten the governance norms. So guys, if I talk about the background, definitely RBI has observed favoritism in the lending practices, conflict of interest, weak governance and possibility of lending. That means एक हाथ दो एक लात लो, right? ये वाली lending practices भी we have seen multiple times. That's what a quid pro quo lending means, something in return for something else, right? So if I am giving you a favor, you will also give me a favor. So definitely we have seen these kind of biasness, and that's why RBI is going to strengthen these related party transaction, and RBI has incorporated definitions, board responsibility, approval processes, whatnot. Okay, so all these things are in the commercial bank credit risk management. So the main part of the circular is RBI has inserted multiple definitions to make it quite crystal clear, plus committee on lending to related party, a board level committee to approve the related party loans is established, right? So a board level committee will be there, and in case if the bank is having any kind of related party, first the board level committee will approve the related party loan, and then only the regulated entity can proceed with giving the loans and advances, right? So lending for the related party includes any kind of funded loan, any kind of guarantee LC, which is in the non-fund based facility, right? We are not giving fund, but instead we are giving a guarantee. So there can be two types of things. I'm actually giving 1 lakh to my relative as a loan. So this is a fund based loan, but I can just guarantee on behalf of my relative. Say for example, he or she is obtaining a loan from a bank. I am giving a guarantee. So that's kind of a non-fund based facility, right? I'm not giving funds, but somewhere or the other I'm giving a facility in the form of guarantee or LCs. Investment in debt securities, I'm investing in their debt security. That is also again a kind of lending practice only, right? My relative has issued a bond. I am buying the bonds of my relative. So I'm making an investment in the debt instrument. It is as good as I am giving a loan only, right? But it excludes the equity investment, right? Equity investment is not about lending. I actually have skin in the game when I am investing in equity shares, and I do have a risk as well, right? Which is not there usually in case of the lending. So related parties ka definition is also given, like promoters, directors, right? A promoter of an entity, a director of the entity is also a related party, or anyone who is holding more than 5% of equity or voting right, right? Or anyone controlling the bank. All these things are related party for a bank, right? There can be additional list of the related parties as well. So later on you can definitely check out quickly. Any entity where the related party holds more than 10% of equity is also a related party, or that entity is controlling at least kind of more than 20% of the voting right or can nominate a director. So these are some of the things which we can say at an entity level will be the related party. What is the crux? Board approved credit risk policy should be there, and it is now mandatory, right? Board approved credit risk policy. A bank needs to have a bank needs to lay down a comprehensive board approved policy, right? Covering each and every aspect, like say for example, if you are giving a loan to the related party, what will be the terms and condition, right? State country risk, state all the kind of risk that you can see in that particular arrangement. Earlier, this requirement used to be there in different regulations, and now this is a consolidated policy which RBI has released recently, right? Some of the old sections are also now deleted. Now the main focus is on the board responsibility. The board must ensure that the safeguard exists. There are certain controls which are restricting, or even restricting is a wrong word, I will say proper disclosure requirement, and no conflict of interest should be there even if it is a related party transaction, right? Aggregate limits of the exposures are also fixed in this particular direction, and there are so many new updates as well. So one by one we are going to discuss about each and everything, right? Aggregate loan exposure, bank has to give overall cap for the related party lending. Bank has to clearly decide how much loan I'll be giving to my related party. So it should be as a cap. There should be a cap, there should be boundaries, there should be limits. Single related cap, there is a overall cap, so there should be a single related cap also. There should be a group cap as well, right? And all these things will be going to be within the limits of RBI prudential limits only. So definitely the bank can decide, but ultimately you can't cross the prudential limits stated by the Reserve Bank of India. But there are certain regulatory prohibitions. That means this is strictly prohibited. That means a bank cannot lend to promoter, relative of the promoter, shareholder holding more than or equal to 10%. So there are certain restrictions also. Right? Then materiality threshold, this is going to be important for you, right? Rest of the things are more related to theoretical stuff, I will say. So better you need to understand the materiality threshold. Loan to the related parties above the threshold must go through the board or committee. So if the threshold is crossing, then the board approval is required or the committee approval is required here compulsorily. Bank asset size is greater than 10 lakh crore, then in that case the threshold is 25 crore. If the bank asset size is anywhere around 1 lakh crore to 10 lakh crore, then the threshold is 10 crore, and if it is less than 1 lakh crore, then the threshold will be 5 crore. Okay. Now you need to understand this materiality threshold. This can be relevant from this particular circular point of view. Otherwise, just an understanding, okay, that we are having a particular committee that is going to approve the related party transaction will also be fine, plus the materiality thresholds, right? And this is applied per transaction. If it is below the threshold, the delegated authority is going to approve, but if it is above the threshold, then the board or the committee is required to approve the same. And the directors, key managerial person and specified employee are going to exclude themselves always related in the discussions in the meetings which are related to the loan discussion, sanctioning, restructuring, waiver, write-off and so on. No participation is allowed here in the meetings which are concerning or which are related to, I will say, which are having some kind of conflict of interest. Okay. Then the banks will be also maintaining the monitoring framework. Now this particular circular is 95% theory and hardly 5% is going to be important for the examination. Okay. So the enforcement power, transition rules, all will be decided by the bank. The effective date is going to be 1st of April 2026. From this particular date, the bank is going to adopt this particular circular. They can even adopt, earlier if they want to, but this is the official date of this particular circular. And here are the summary pointers. You can quickly read it. Just the threshold is important, plus the concept of committee is important. Otherwise, you can just quickly read it. Not so important for the examination perspective, right? The next one again is related to commercial banks, financial statement presentation and disclosure. So there are so many circular related to this. We can have a look. And all these circulars are related to the presentation and disclosure requirement for commercial bank, small finance bank, local area bank. Same requirement is there. Okay, so it looks difficult, but it is very easy. It is nothing but a change in the disclosure requirement. Will this be coming in the examination? I will say not so important for your examination perspective, because these are just the disclosure requirement. So we are doing an exclusive coverage of the RBI circular. If you watch any of my video, all the circulars will always be covered, right? I don't skip circulars, so you can have assurance. And I also tell you guys what can be important for the exam and what is, you can just read it and ignore, or there is no need to read it also sometimes. So this is regarding the credit risk management, which is again the risk management. The risk is emanating from the related party transaction, and that's why RBI has given a detailed disclosure requirement. You need to disclose in your financial statement in the notes to accounts. Now, if I have taken a loan, let's suppose if I have given a loan to a related party, I am a bank, I am a financial institution, I have given some loan to a related party. Everything I can't disclose it on the face of the balance sheet, right? It will make my balance sheet too messy. So that's why we do have notes to accounts, which is an integral part of financial statements only. As per section 2 subsection 40 of the Companies Act 2013, we do have 5 types of financial statements, right? No doubt banks are preparing the financial statements based on RBI circulars, based on the Banking Regulation Act. But I will say broadly the structure is the same only. It's just the difference in the business model which is causing a different way of preparation or presentation of the balance sheet. So this is the way in which we are going to disclose the loan to related party and contracts and arrangement involving related party. So now I don't think this particular thing can come in the examination. So as of now, not required. You can just give it a quick reading if you are interested in reading, like aggregate value of the loan which is sanctioned to the related party. What is the aggregate value of outstanding loan, right? Now, what is the outstanding loan as a proportion of total credit exposure? Let's suppose your total credit exposure is 100, but the loan given to the related party is 20. So you need to separately disclose this thing that out of 100, we have given 20 to the related party, right? Special mention accounts, NPS को अलग-अलग classify करना है, and this requirement is there. So it is just a disclosure requirement, not so important for your examination perspective. Okay. Now the next circular is about the Prudential norms on capital adequacy. So again, it is Prudential norm on capital adequacy. So for commercial bank, small finance bank, and all India financial institution, we are going to study. This is nothing but an amendment direction. Okay, so this is a very straight and very simple amendment direction, right? If you guys do remember, few months back we have studied this news related to Care Edge Global IFSC Limited, right? Care Edge Global IFSC Limited. Now this circular relates to the amendment for the Care Edge Global IFSC Limited only. The amendment is all about how the bank has to calculate the risk weight and how the banks will be calculating the risk weight. RBI will be defining the risk weight, right? And if the risk is high, the risk weight will also be high. So how to calculate the risk weight on loans to non-resident corporate? Let's suppose a company has given a loan to a non-resident corporate, and specifically when it is routed through IFSC. So let's suppose I am in the gift city, right? I am operating in the gift city. Now I have given a loan to a non-resident corporate, right? I can also avail the services of Care Edge Global IFSC Limited for the rating purpose, right? For the rating purpose. So RBI recently recognized this Care Edge Global IFSC also via a notification, I think anywhere around 6 to 8 months back, right? 6 to 8 months back. So because we do have a new rating agency here, now RBI has to redefine the risk weight for the non-resident corporate exposure, special treatment for IFSC originating exposure if the originating is if the originating area is IFSC, then in that case the exposure limit has to be defined, right? And the list of approved international credit rating agencies as well. So here in this table we can see that claim on non-resident corporate risk weight mapping for rating assigned by S&P, Fitch and Moody, right? So here 3 rating agencies are there: S&P, Moody's and Fitch, right? So S&P and Fitch will go hand in hand. right? S&P and Fitch will go hand in hand. And similarly, if the person is getting the service of Care Edge Global IFSC Limited, and in that case, the risk weights will be different, right? The risk weights will be different. So what changes are there in the risk weight? Here we can see that if the rating is AAA to AA, in that case, a weight of 20 is assigned here. Similarly, if the rating is AAA, a weight of 20 is assigned here. But in case of AA, a rating of 30, a risk weight of 30 is assigned here. Okay. So, but in the case of S&P and Fitch rating, as well as the Moody rating, 20 is assigned to AA as well, but here AA को 30 दे रखा है. Okay. Then if it is A, it is 50. Here it is also 50. B के बाद वापस आपका 100 हो गया है ना. Below double B आपका कितना हो जाएगा यहाँ पे 100 हो जाएगा, और double B and below double B here 150 will be there. Okay. So this is nothing but a risk weight chart. So sir, do we have to remember each and every risk weight as well based on the different ratings? I will say no, right? Just try to remember the difference of this one. Okay. That to a plain reading, not so important for the examination perspective. Okay. Now, if unrated claim is there having a exposure from the banking system of more than 200 crore rupees. So say for example, a unrated exposure, a unrated claim is there. Suppose somebody has given loans to the non-resident corporates, right? And that is unrated. Rating has not been done. So in that case, if the exposure is of more than 200 crore, then the risk weight of direct 150% will be assigned. Okay, because this is highly risky because it is not at all rated, right? Provided that it is more than 200 crore. Then claims with aggregate exposure from the banking more than 100 crore, if the exposure is more than 100 crore, which were rated earlier and subsequently have become unrated. So earlier rating was there, but now rating is not there. It will also be attracting a risk weight of 150%. Okay. And one more thing which is written here is no claim on an unrated corporate shall be given a risk weight preferential to the assigned to its sovereign of the incorporation. In simple language, let's suppose there is a country XYZ and the risk weight of this sovereign securities of this country is, say for example 80, for example, right? If there is a unrated corporate, a corporate which is unrated, and we have given a loan to this unrated corporate, so this is an unrated corporate loan, cannot get lower risk weight than its home country sovereign. So the home country sovereign XYZ is having a 80 ka risk weight. Now this company cannot have lower than 80 ka risk weight. Why? Because the government ka sovereign, right? The government ka sovereign bonds or any other securities is having a risk weight of 80. So how can the corporate loan of the same country of this company be less than 80, right? So this is a kind of restriction that you need to know. Okay, this can be important definitely. Otherwise, definitely these two things you have to learn. But I don't think rating wise you have to learn, kind of the risk weight, because the risk weight keeps on changing. Okay. Now guys, let's discuss about the Foreign Exchange Management Guarantee Regulation 2026. So this is all about guarantees in the Foreign Exchange Management Act. Okay. So RBI has issued the new FEMA guarantee regulations as of now. Earlier also we used to have, but now we do have a one consolidated regulatory framework, right? So any guarantee involves a person resident outside India, then this particular direction is going to be applicable. Okay, any guarantee involves a person resident outside India, then we have to use this particular circular. Acha, what do you mean by a guarantee? Say for example, you have taken a loan, right, from HDFC Bank. Now I am giving guarantee to HDFC Bank on your behalf. So let's suppose if you are not able to pay the loan off, I need to pay that loan, right? That is my guarantee. So let's discuss one by one, guys. Whenever the entities are issuing, modifying, invoking the guarantees, they need to follow this particular regulation. Any guarantee involves a person resident outside India. So if a person is there, who is a resident outside India, then these rules and regulations are going to apply. Otherwise, we do have different guarantee rules and regulation, right? So we are all, kind of reading this. Why? Because we need to comply with the FEMA compliance, and this is a part of FEMA compliance only. The major change is comprehensive guarantee reporting. Okay. So in this particular circular, there is a comprehensive guarantee reporting, which is a major change. Earlier, we used to have different formats, different returns, and multiple circulars, but now we have a one short circular to cover all the things. So all the guarantees must be reported in one format, which is called as GRN, Guarantee Reporting Number Form. This is important for the examination perspective. It's only one form now, GRN, Guarantee Reporting Number Form, right? So after this direction, RBI will be getting end-to-end visibility of each and every cross-border guarantee, right? So let's start the detailed discussion, guys, related to the Foreign Exchange Management Guarantee Regulation. The very first thing is the definitions. We are first going to learn the definitions, okay? So first there is a debtor, which is called as principal debtor here. There's a creditor. Say for example, HDFC Bank has given a loan of 1 crore rupee to this debtor. Now somebody needs to give a guarantee. So we do have a surety as well. This surety will be giving guarantee on behalf of the debtor, right? On behalf of the debtor, the surety has given the guarantee to the creditor that if the debtor is not paying the money back, no worries at all, I am there, right? Surety is there to take care of it. So guarantee, it is nothing but a contract to repay or perform obligation. This loan is an obligation. Now surety will be repaying or performing the obligation if the principal debtor defaults, right? So if the principal debtor is defaulting, definitely surety is going to cover the default, right? Creditor, the person who has to whom guarantee is given. So here I have given guarantee to the HDFC Bank. So creditor is nothing but a person to whom I have given the guarantee. Principal debtor, this is the person whose default triggers the guarantee. If this person is defaulting, then the guarantee will be triggered, right? The guarantee will be triggered, and the surety, person who is actually giving the guarantee, is surety, right? So some of the core rules that we need to know from this particular circular: no Indian resident can be a part of guarantee involving a non-resident. So as a rule, no Indian resident can be a part of guarantee involving a non-resident, right? So you can't be debtor, you can't be surety, you can't be creditor, unless allowed in these regulations or RBI permission. So the whole crux is, if you want to enter into a guarantee agreement with a non-resident, you need to take the RBI permission. The first thing is, maybe it is allowed under the regulations, but if not, then you need to go for the RBI permission. You can directly enter into an agreement with a non-resident involving a guarantee agreement, right? So this becomes a starting point. You can say the cross-border guarantees are now restricted by default. The cross-border guarantees are now restricted by default because there is a risk involved in it, and that's why RBI steps in. Now there are certain exemptions as well. For example, these exemptions are going to be outside the regulation, so no compliance related to these regulations are required, because maybe there are also even tighter regulations which are already in place. Guarantees by the foreign branch or IFSC branch of AD bank, right? So say for example, there is an authorized dealer bank, and now that particular bank is having a foreign branch or the IFSC branch, right? So this kind of guarantee given by the foreign branch or IFSC branch of the AD category bank is not required to comply with the provision. Say for example, SBI Bank London. Now this is a foreign branch of a AD category bank, right? This is a foreign branch. SBI ka branch is SBI London. SBI London is giving guarantee to UK company which is outside FEMA, right? Which is outside FEMA. But if another party is an Indian resident, in that case, the rules and regulations will start applying, right? Unless and until the another party is an Indian resident, we don't have to follow these rules and regulations. Then the next one is irrevocable payment commitment, issued by the AD bank acting as a custodian. The principal debtor is a FPI, foreign portfolio investor. The creditor is authorized CCP in India. So can I say, as debtor we do have FPI here. Then we have creditor as CCP, central counterparties, right? And on behalf of FPI, here the AD bank is giving a guarantee to the CCP, So I can say that AD bank is merely acting as a surety here, okay? So here the arrangement is like FPI is trading in the Indian market, right? The custodian bank is giving a irrevocable payment commitment to the central counterparty. Central counterparty settles the trade confidently. Why? Because custodian bank is there to take care of it. AD bank is there to take care of it. So in case FPI fails, the bank is going to pay, right? So this ensures zero settlement failure plus the market stability as well. So in this kind of arrangement also, the regulation will not apply. The regulation is not going to apply. Guarantees under the overseas investment regulation, because there are already the investment overseas regulation drafted for the purpose, right? Then in that cases, the guarantees covered under the overseas investment regulations will not be covered by this particular direction. Now, when the Indian resident can act as a surety or principal debtor, that means when the Indian entity can be a part of the guarantee agreement, it is allowed only if the underlying transaction is FEMA permitted. So if the transaction is clearly mentioned in FEMA, it is clearly permitted. The condition number 1 is satisfied. The condition number 2 is surety and debtor are eligible to lend or borrow money under the FEMA borrowing and lending regulation. So we do have FEMA borrowing and lending regulation as well. If it is permitted in that particular regulation, it is permitted here also. Okay, so two conditions are there. Underlying transaction permitted plus surety and debtor are eligible to lend or borrow under the FEMA regulation. But condition B is not at all required when the AD category bank gives guarantee backed by 100% foreign deposit or counter guarantee, right? So here the condition B is not at all required to be complied with. So let's suppose if the Indian AD bank is issuing only issuing the guarantee after receiving the full cash deposit in the foreign currency. After receiving full cash deposit in the foreign currency, then that's fine, there is no risk at all. Or maybe it is secured by a counter guarantee from the overseas bank. So let's suppose SBI is giving a guarantee, right, to the foreign party, but some other bank in the foreign entity, let's suppose JP Morgan is giving a counter guarantee from the overseas bank. So I can say that bank is having a zero risk. In that case, in that particular case, AD bank can definitely give a guarantee, but it should be 100% backed by a foreign deposit or a counter guarantee, right? In that case, this B regulation is not required to be complied with. It will be even fine, even if the transaction is not mentioned as a borrowing or lending regulation transaction. Next one, Indian agents giving guarantee for foreign airline shipping company to the Indian government or the statutory body. Now, for example, a foreign airline is coming to India, right? Now, airport authority will be asking for a guarantee. The Indian booking agent is providing guarantee on behalf of the foreign airline. Now, in that case, no need to comply with condition B. Why? Because this is a routine trade operation, right? A short-term commercial exposure and plus no capital flow of risk is there in this particular transaction. Both the surety and the principal debtor are Indian residents. If both the surety and the principal debtor are Indian resident, then no worry at all. Say for example, Tata Motor gives a guarantee loan to Tata Steel, right? Tata Motor gives guarantees a loan of Tata Steel. Tata Steel has taken a loan and Tata Motor is giving a guarantee for Tata Steel. Now both are Indian residents only, so RBI doesn't apply any kind of cross-border borrowing check for such a kind of transaction, right? Now the crux is every guarantee must be reported, and who has to report it? The Indian entity has to report it. If the surety is an Indian, you have to report it. If not, then principal debtor maybe is an Indian. Principal debtor has to report it if the surety is a foreign party. If both the parties are foreign parties, surety and principal debtor, then in that case, the Indian creditor has to report the transaction. The whole idea is the Indian entity has to report the transaction to the Reserve Bank of India, right? So issue of guarantee, any kind of change in the terms or invocation of the guarantee, each and everything should be reported here. The reporting flow will be the person will first intimate to the authorized dealer category bank, and then in that case the AD bank is going to report it to the RBI. The timeline, the person will be reporting the AD category bank quarterly within 15 days of the quarter end. So let's suppose the quarter end is there and within 50 days you have to report. Then AD category bank within 30 days of the quarter is going to report to the Reserve Bank of India, and there is a late fees as well here, right, which is going to be applicable if you are not reporting the transaction, right? So a very simple, a very process oriented direction, Foreign Exchange Management Guarantee Regulation 2026, right? Don't go into too much details of this particular direction, not required for your examination perspective. Just a brief understanding will also be fine, right? At the end I have given the summary pointers as well. Now guys, we are going to do a very quickly a discussion related to the SDQI, which is Supervisory Data Quality Index for the Scheduled Commercial Bank. So recently the data was released on 6th of January 2026, and we can see here the SDQI score of Scheduled Commercial Bank is 90.7. Now I have already covered this data related thing in the finance current affairs session, but still we are going to have a very quick discussion related to the data of SDQI, because in RBI Circular series we cover all the news which is there on the RBI website plus the RBI circulars, right? So SDQI score, there are so many parameters like accuracy, like completeness, like timeliness, like consistency. So there are so many banks, whether they are accurately submitting the data, whether they are submitting the complete set of data, whether they are timely submitting the data, and whether consistency is there in the data or not. RBI is having these 4 parameters, and RBI releases a SDQI score after verifying the accuracy, completeness, timeliness and consistency. And as here we can see, in June 2025 the SDQI score was 89.9, and as of now this is the data of September 2025, 90.7. So I can say there is a overall improvement in the SDQI score, right? There is a overall improvement in the SDQI score, and in the parameters I can see completeness is the one with the highest number, then we do have timeliness, then we do have accuracy, and the last one is consistency, right? Acha, among different groups I can see that a small finance bank is having the highest number. So small finance bank is having a number of 91.5. 91.5. Now that's very amazing number as compared to the others. Then public sector banks are outpacing private sector banks in terms of the SDQI score is what I can again see here, right? Acha, in the parameter side, only small finance bank is scoring 100 in terms of completeness, right? So this becomes the highest score in terms of completeness, 100 out of 100. No miss outs, okay? So that's a very amazing score I can say. And here you can see that less than 70 ka score is major concern. We don't even have that particular score as of now, right? We don't even have we don't have any regulated entity which is falling below 70. Between 70 to 80 needs improvement, right? So between 70 to 80 orange, we don't have it, okay? So there is no regulated entity which needs improvement as of now in India. Everybody is already, kind of following the set track. Between 80 to 90, this is the one, 80 to 90, 30 regulated entities are there, and this level is acceptable. More than 90, 57 entities with good score, okay? So SDQI wise, I can say that we are doing very well. Timeliness, there is an increase in the graph. Completeness, slight decline, no worries at all. Accuracy, there is a decline, and consistency wise there is a increase. So can I say that timeliness and consistency is going up, whereas timeliness and consistency is going up, but completeness and accuracy is going down as per the recent trend, right? Plus the impact is not as high, right? It is just a slight decline in case of accuracy and completeness, right? Overall SDQI wise our score is going up, and which is great for all the regulated entities. Right guys, so that's all from my end for today. Thank you so much for attending the session. I hope you have liked this session, right? If you like this session, please do hit the like button and do subscribe to our channel. Do join my Telegram group as well, because I frequently share finance related updates on that particular group, and you can definitely reach out to me as well in case if you face any kind of difficulty. So thank you so much guys. See you soon in the part 2. Bye bye. Take care.